In the midi, I just start with a small story about how the money was created. Right. In the title itself, I have given money equal to bill. So money, so the currency what we are using today, right? So whenever we are talking about, or when we are talking about a currency or money, you have to always think about a bill, right? So who is going to create this bill and how it was created? So I will give you a small story about the money, first of all, right? So in the medieval Italy, mostly the merchants and savers would store their money, store their gold or silver coins with the goldsmith, and the goldsmith will issue a receipt in return of that gold or silver. Right. So they usually what happen is they will get the gold and silver. So they trust the goldsmith. They go to the uh, goldsmith and they give the valuables to the goldsmith. In return, that goldsmith will put a receipt. What are the things he had collected, and he will return like a receipt to that people. Right. This is what happened 200, 300 years before. But there was no paper money was created. But when the time moves upon and people wants to go to one place to another place to do trade, they want to from Italy to France and to England, like that, they want to go and do trade and they want to buy a uh, product and carry over there to the Italy. Then it becomes a problem because all the values belongs to with the goldsmith. So these goldsmith come upon with a better idea. So they open a branch in another country, like they do the same thing in the area. For example, one goldsmith go to the uh, German and another goldsmith go to the France. So they do the same thing, like they get the gold or silver, like everything, and they put a receipt. So when the time moves upon, everyone knows about that. If the receipt is there, I can get back the valuables like gold or silver from that goldsmith. So when times move upon, instead of changing the real gold or silver coins, people started to use that receipt or bill which was given by the goldsmith within themselves for the trade purpose. So when all the gold and the silver coin went into the uh, goldsmith's locker, and the receipt only given by the goldsmiths will be traded as a currency, right? This thing is going very well for 50 to 100 years, like the time. But there was another person who come into the business, banking business, called Rothschild, right? So when we have to know about the money or a banking uh, system, we must first know about who is Rothschild and how the family runs the banking empire, right? Without knowing Rothschild, we can't do what banking is. We cannot understand about banking is. So what Rothschild did is he also like uh, doing the business of giving the receipt. He was getting the valuables uh, from the individual, from the people, and he was also giving the receipts, and he was taking care of that. Or sometimes whenever they come with the receipt, they will he returned. He started to charge some interest for that. When this business was so good, so he sent his 5 sons to different places like Vienna, Frankfurt, London. So each one of the son goes to some various different kinds of places. They started doing the same thing, right? So what people came to know is, when you have a receipt of a goldsmith's sorry, Rothschild's receipt. This receipt will can get you some gold and silver coin from their lockers. This is how it was going. Everything was fine until the starting of 18th century. But in 18th centuries, there was a war broken out between Napoleon and the uh, British Empire. It was Napoleonic War. It was comes at the time of 18th century, early 18th century. So Napoleon wants to win the war at any cost. So when there was a war broke out, right, the king who is spending more money to buy the commodities like steel, iron, like that, who is spending more on this kind of commodity can win the war easily. So at one point, Napoleon realized that people are more aware about the Rothschild's receipt, that is bill given by the Rothschild. If he has that receipt with him, he can buy more amount of commodities from the market. So from other countries like that, so he can win the war easily. So he approached one of the Rothschild member to give some receipts so that he can win the war. So when he was doing that in the France, yeah, another Rothschild's son, Mayor Rothschild, was in London. So British Empire also doing the same. They also getting the receipt from the Rothschild bank, and using that receipt, they are buying commodities like steel and iron, whatever they want to make some big uh, army vehicles like that. So both there are two countries in the war, uh, Napoleon and the British Empire, and both are getting receipts uh, from the Rothschilds. But the problem is, all these receipts are not having any valid gold or silver. So there is no any valuables stored in that for all these receipts. So the war was going. So both the kings are fighting for their uh, chance of winning purpose, but indirectly, one family was running the entire world's entire. Because at that time, in the 18th century, France and England are the world's biggest emperors. Okay. So once the war get over, both the emperor wants to return the money back to the Rothschild banks. But the problem is they don't have that much of money with their empire, because of whenever there was a war, there was a huge loss will happen. So instead, what they came to do is, which changed the entire thing about our knowledge about the banking system. So they introduced, instead of commodities at the time, till then they used so much of commodities for the transaction. So both the British and France Empire introduced the system called money. So whatever the Rothschild did is become a legal tender from that time onwards. So then all the valuables like gold, silver are kept in the uh, bank's locker, like RBI reserves. They have introduced the paper bill, called what we call it as a currency now, right? So this is how money was created in the 18th century. Till then, from here we are 200 years, still we are using that paper bill as a for every purpose, right? So still we are doing the same. Like for example, RBI will buy a gold and they kept in the reserve. Instead, RBI governor will issue a printed bill, which was signed by RBI governor, and we are using it as a currency. The same system was using till now. But the problem is when we are buying, when we are having that money, the value of the money will reduced because of the inflation. Can any of the members tell me what is meant by inflation? Any idea about inflation? Okay. Okay, I will explain. Inflation is nothing but when Norway is printing more and more money.
More circulation in the economy, sir. Higher the prices, more circulation in the economy.
Okay, thank you, Venkateshwaran sir. Higher, when there is a more circulation of money in the market, then the value of the money will become decreases. Most of the time, people will misunderstood that inflation is rising, the price increase of the commodity is called inflation, but even a lot of commerce people also misunderstood that inflation means every year the price of the commodity will go up like that. It was created by inflation. But the real thing is, it happened because RBI was printing more money for circulation. When people are having more money with them, they are ready to pay more. So the value of the
Money is diminishing, sir.
diminishing. Yes, very exactly. So here I have given a recent RBI circular. So RBI wants to have the inflation target around 4%, but and when we take, I will show in the next slide, when we take the historical inflation of India, it was around 7% to 8% like that. So government was trying to commit reducing it below the 4%. Still, we are at a 5.6 to 6% in the last year also. Right? So before I explaining about the inflation, I want to give you another perspective how the money was printing. Okay, so in the initial stage, for example, 200 years before, the money was printed when the gold or silver coin was kept in the RBI. Today also, RBI was keeping the gold as a reserve. Right, this one everyone knows very well. Can anyone tell me that what are the other instruments which RBI keep in the reserve to print the money? Can anyone tell me that? What are the other reserves which RBI can keep in the reserve and to print the money?
Bills of exchange, certificate of deposits, gold, bullion, sir.
Okay, bullion. Thank you. Bullion and gold are the same thing. Bullion.
Yes, sir. Bullion is nothing but gold. Apart from that, certificate of deposits. So some securities, which is in term of in the form of material worth.
Yeah. For example, we can simply say it as a bonds. Government bonds are
Government
gold
bonds. Yes,
Yeah.
yes.
Very good. So there is a third thing. There is one thing is there. It was called balance of payment. Right. Today, RBI is printing money for balance of payment also. So there are three things which RBI is printing money. One is bullion, that is gold. So whatever the gold they keep, they print the money. Second thing is foreign exchange, and third one is balance of payment. Right. So what is balance of payment? So other two things easily people can understand, but what is balance of payment? Why we have to print bill for balance of payment. So I will explain it in a detailed manner. So 2 or 3 years before, uh, Reliance company, the company Reliance has sold their 10 percentage of Geo uh, Geo payment shares, right, to Google. So Google has bought 10 percentage of share in Geo for the amount of 45,000 crore rupees, right? But for Google, all this 45,000 crore is they having it in dollars. But what Reliance need is Indian rupees for their payment purposes, right? So it needs to be transferred to Reliance as a Indian rupee. So how they are doing it? So for when Google was sending the money to a Vastra account called Vastra account. So anyone know about Vastra account? Any idea about Vastra account? Anyone?
Astra account, the world account, sir. World account for dealing the transactions of different currencies.
Okay.
Nostro, Vostro.
Yeah, Vastra. Okay. So
Nostro.
which means for for mostly everyone knows that all the international transactions are happening through American dollar. So each and every country needs to open a account in American banks. So our bank, like for example, we take SBI Bank, will create a account in any American bank. So that for example, the Google will pay to that amount, that 45,000 crore equivalent American dollar, to transfer to the Vastra account. Then that SBI, after receiving that Vastra in dollars in that Vastra account, they give a bank receipts to the RBI that they have so much, this much of Vastra account is there. But the problem for RBI is now this 45,000 crore is not printed by RBI, but this 45,000 crore was entering into the Indian market newly. So RBI has to take a decision whether, if they have already having that much of uh, Indian rupee in their account, they can transfer the money to that. Whoever the Reliance company shows, they will transfer it. But if there was a deficit in RBI's balance of payment, then they have to pay the print that 45,000 crore. So for having foreign currency, we can, for the purpose of balance of payment, we can print the money, right? So for the gold, so there are 3 things I already told. One is for Boolean reserve, that is called gold. Whatever the gold they are having, they can print. Second one is foreign exchange reserves. Third one is for balance of payment purpose, they can print, right? My another question, why inflation is so high is most of the people think RBI will print only once for the gold. For example, let me take RBI is having 100 tons of gold in their reserve in the year 1990. Right? In the year 1990, RBI is having 100 tons of gold. At the time, that means 30 years before, the gold was so cheap that the 1 gram of gold is around 200 to 300 rupees only, right? So RBI getting that 1 gram of gold and keeping it in the reserve, they are printing equivalent as a money currency. But my question is whether that 100 tons of gold still in the reserve of RBI or not. Yes, of course. They are keeping that safely in their wallet. All the 100 ton is there in that wallet for last 35 years. But at the time when they are buying that gold, they just printed only 200 rupees. But what is the current value of 1 gram of gold? It was around 6,000 rupees, right? Whether RBI is allowed to print 6,000 rupees or not? This is the first question. Can anyone tell? Can RBI print 6,000 rupees now? Because they are already bought and kept the gold for so many years, right? Whether they are allowed. Yeah. Anyone? Okay. So RBI is always calculate their gold value with the international gold price every year, and they are allowed to print to the international standard value. So what that means is RBI will print whatever they are keeping. So that doesn't mean only for the new gold which was RBI buying they can print. Doesn't mean like that. For all the gold reserve they are kept in the wallet, they can print money for that. Okay. Then it comes to inflation, higher inflation, because in the last 2 years when there was a war broke out in Ukraine, right? The gold price was skyrocketed. It was up by 50% in the last 2 years, up by 50% in the last 2 years, right? Why every time there was a war came, the gold price was going high? The war and the gold price are always related to each other. Why? Because whenever there was a war happens in the world, right? People wants to move from one country to another. They will go for as a rescues, and they will go into the other countries to for their safety purposes, right? At that time, when I am having land as an asset, I can't take the land with me, right? Second thing is when I am having money, if I take that money to other country, my country money will not be used in that country. Okay? So there was a safe assets which can be taken to anywhere in the world, and you can use it as here. Currency is only thing is gold, and gold is very easy to carry also, right? So whenever there is a war broke out in the world, anywhere in the world, the gold price will shoot up. So what happened because of this Ukraine war? When the gold price goes up, RBI has started printing more money because the value of the gold was going up. So if you have watched the news, probably last year, RBI has given a dividend of 2 lakh crore rupees to government. Where the 2 lakh crores come from? Because when the gold price was higher, so RBI printed money and they are giving that money to government for the purpose of the government will use for developing the infrastructure and everything like that, right? So this is how it happens. So whenever the gold price goes up, RBI print more money and gave it to the government, and government spend it, and the money will comes to the hands of the people. When people having more money, they are ready to pay more, the inflation will continue, right? So the next slide, I just put it India's inflation rate for from 1960 to 2000, right? You can see after 2000 there was steady flow in the inflation rate, but before that there was a very high fluctuation, right? We can see here during 70s, right? The inflation was so high. It was touched about 30%. Okay. So why that time there was a huge spike in the uh, inflation rate in India is because in the 1971 we have go into a severe war with Pakistan, right? So at the time the inflation rate was around 30%. After the war was over, the inflation rate comes to nearly negative. And we can see another spike. In the last spike, we can see it around the year 2000. Okay, the inflation rate went up to 15%, right? At the time, we went to a war with Pakistan, Kargil war. So whenever there was a war, that's a spike in the inflation rate. So because why it happened? Because whenever there is a war, the gold price goes up and the inflation rate will high, right? So, but current government was very much strict with their policy to keep the inflation rate below 4%, and which was a good sign for Indian economy, right? So in the next one, growth equal to demand. So I just put a we all wants to invest our money, and we have our money needs to grow at a good rate of return, right? This is where everyone look into it. There are so many instruments, right? There are some gold as an instrument, investment, real estate as an investment, stocks, bonds, mutual fund, retirement plans, commodities, insurance, everything is there, right? So which is the best type of investment of the listed? In your point of view, which one among the listed is the best type of investment? And can anyone tell me that which one you will prefer to invest?
Gold is the best investment avenue, sir.
Okay. Why, sir?
Why means because gold, at least we have that the value. It may undergo some fluctuations, but it will be remaining ever, like the pricing will be high forever, sir. In case of
Okay.
real estate, if we invest, sometimes the capital appreciation will be there in a real estate.
Very good. Yes.
In long run, we can enjoy the benefits. Whereas in
Okay.
case of a stock, it is highly volatile in nature. All the
Okay.
pestle factors will be influencing the stock.
Okay. Very good, sir.
So,
Very
in
good.
terms
Thank
of
you.
reserve, those who are planning in terms of reserve creation or accumulation of wealth, we can prefer gold, sir, instead of other avenues.
Okay. So, what Sarah said is a good point, but I just want to change everyone's perspective towards the gold, right? So, in the last few slides, I have explained about whenever the gold goes up, RBI will print more money. What we will do is we go and buy again the gold. So the gold price will go up. So RBI again put the new value for the gold, and they will print more money, right? So there was a relation between gold inflation and printing the money, right? So gold is the safest investment because it was kept in the reserve of a federal bank, right? So gold is not giving any return actually. It always keep that. It never comes or decrease your money value against the inflation. For example, if the country has having an inflation rate of 5%, right? What that means is there was an increase in the gold price. So RBI has printed more money to give into the circulation, right? So each and every time there was a spike in the gold price, the inflation is also increases, right? So both the gold value and inflation rate is equal in India for last 100 years, which I will tell you. We may think that around 8 gram of gold is around now 56,000 to 57,000 rupees right now. In 1920s,
78,000, sir. 78,000,
10 grams is 78,000, sir. I am talking about 8-gram gold. Okay. For example, you go back to 1920, right? When our great grandfather was there. That time, 1920, that 10 gram of gold is around 20 rupees. The same 10 gram of gold is now 78,000 rupees. Right? We may think it was so much growth is there, but for the long run, gold has returned just give a return of around 6%. Okay, 6%. What that means is that is they have kept the value of the gold, which beat the inflation. For example, if I keep a 100 rupees note, which will be valued 95 rupees next year, right? But when I keep 100 rupees of gold, that will be 105 rupees, which was equal to the inflation rate. So gold is not giving any returns actually. It was just beating the inflation. Right. First thing is that. Second one is real estate. When it comes to real estate, Sir has mentioned, Medishnu Sir has mentioned that there was no liquidity when we are investing in real estate. When we have gold, we can easily encash that gold as a money, right? But when it comes to real estate, if I invest in a real estate, even investing in the real estate itself need a huge money, and I cannot change or convert in the real estate into the liquid cash all of a sudden, right? So I cannot, if I am having a 50 lakh worth of land, right? If just I want only 5 lakh immediate cash, right? I cannot take away from that real estate. So there is a liquidity issue in the real estate. And all of this, when you go in deep into the history of real estate, in the long history, you take grandfather and great grandfather, when the real estate people started investing in the real estate is just in the last 30 years only. Before that, no one was treated real estate as an investment, right? Just 30 to 50 years like that. Only in the last 2 generations only invested in the real estate. Why this real estate has so much of attractiveness in the last 50 years? Because there was a huge demand created in the market. So 2 or 3 generations before, people live in a single family or joint family where 8 or 9 kids all together live in a same single house, right? When there was an industrialization happened after our independence, when there was industrialization happened, people tends to move to the city, and for each family there was 8 kids. Then the next generation, one house is equal to 8 houses. That means around 500 to 800% of demand created, right? So this demand is converted into the growth factor. So in the last 50 years, people who invested in the real estate, because of this so much of demand created in the market, because each family has 5 kids or 6 kids like that, everyone wants to buy a new house for so from one house to 6 house in the next generation. So there was a huge demand created in the market, right? But what will happen if we all have only one kids for the next generation? That was the biggest problem in the real estate, because there was no big demand will be created. Because if I am having only one kid, one son, then my one house will be transferred to him, right? Even that will be just we are replacing that real estate. Whatever each generation will just replace 100% of um, demand, which was replaced every year, right? So we are going into that phase from huge demand to negative demand. In the next 20 to 50 years, maybe you can take China as an example. Chinese real estate are going down in the last 2 to 3 years. Whoever invested in the Chinese real estate market, everyone will suffer a loss in the last 2 years, 3 years, because China is going into a population degrowth phase. So which will be attained in India also in the next 10 to 15 years. So whatever the real estate we have invested will not give the same return as the last 50 years, which has given us, right? So real estate is also not a good investment. Then comes stock, bonds, mutual fund. These are the financial instruments, and which is very new for us. In the last 10 to 20 years only, we are came to know about the existence of mutual fund, insurance, like this, right? So then comes stocks. So today I'm going to explain more about how you have to invest in your shares. This is the part I am going to cover in the next 1 hour. So whatever the gold, commodity, these all things gives you return because there was an inflation, right? I am buying a commodity. For example, I am buying a silver or aluminum, like that. It was a commodity. I am just buying it. The value of that commodity will increase next year because only there was an inflation is there, right? But when I am buying a stock or I am buying a business, right, I have going to attain two kind of returns. That is the only advantage in the share market or when buying a share. What the one, because of the inflation, the price of the product, whichever the business is, right, the price of the product will increase. So we easily come over the inflation in the business. Second thing is, when I am doing a business for 100 customers this year, then the number of customers will increase in my business. So this year I am doing business for 100 customers. Next year I am going to do business for 110 customers. So there was a 10% growth. Another type of growth is because of the inflation. Last year I sell my product for 100 rupees. This year I am selling my product for 105 rupees because there is an inflation of 5%, right? So totally I am getting 15% return in the business. So business is the one thing which gives you a more return than all these commodities like gold, commodities, real estate, which are, right? All the other things, right? For example, bonds, retirement plans, for example, public provident fund, EPFO, NPS, insurance. When you are putting the money in the bank, everything goes into the business. That means share market. Right? I will explain how it will go into the share market, right? So first thing about share market is, can anyone tell me what is meant by a share or equity share? Can anyone tell me what is
Equity
share?
represents ownership capital. Equity represent ownership capital, a part of part of divisible profit. Share is a part of divisible profit. Equity share
Divisible.
represent ownership capital in the company. And
Okay.
share is nothing but it is a security which can be traded in the capital markets.
Okay. Very good. The ownership is the word I am just looking for, and you get the point correct. So most of the people, what thing is the share market? When I am buying a share for a price, and when the price was going up, I have to sell that and take away the profit, right? But the share is not like that. First thing is there are two things. One is trading and another is investing that is available in the market. So whenever I buying a share, I am paying that price for the ownership in that company. This is what I want to convey. So unit of ownership is the share, right? So then how to calculate that unit of the ownership? It was calculated as a face value of the share, right? So tell me any one company, right? We will go in depth and check in the
IOCL, sir.
IOCM. Okay. Thank you. So now I will share another screen. So is my Google is visible? Okay, just I am just typing BSc and going into the BSc website. Is it visible for everyone?
Yes, sir, it is visible.
Okay. So as you required IOCL, okay. So can you explain what is IOCL? Indian Oil Corporation, right? Okay. So I'm just going into the IOCL page in the BSc site, right? Some of the basic things are mentioned here, right? Here they mentioned it as a face value, right? Everyone see it? Face value.
Yes, yes, face value.
Yeah, face value. Face value is
143.45.
no. Face value is just 10. Here I am just marking it with my mouse.
Yes, sir, face value 10 rupees.
Yeah, 10 rupees. But the share price is 143.55, right? Then what is face value determined is this is the value of the actual share, right?
Per
For the
individual
10,
share, per individual
yeah,
share of the
for
company.
individual share, the actual share value is 10 rupees, but that share was trading at 143 rupees 50 paise, right? So each and every share was splitted as a 10 rupee share and it was trading. So for understanding this, we have to know about what is shareholding pattern. So Indian Oil Corporation, everyone know about Indian Oil. Okay. So I'm just going to show you the shareholding pattern of Indian Oil. Who is the owner of the Indian Oil company? Can anyone tell me who is the owner of the Indian Oil company? It's a government company, right? So Indian Oil is an Indian government company. So in the BSc website, I'm just going there. You can see here it's in the orange color, shareholding pattern, right? So I'm just clicking that arrow mark here. So the shareholding pattern is visible.
Visible, sir, visible.
Okay. So there are two categories are splitted in the
Public
share.
promoters of
One
the
is
company.
promoter of the company and public.
Government,
Okay.
actually it is government, sir, and others no promotership. Only public is public sector.
Okay, it's a public sector company. For every public sector company, government is the promoter of that company, right? So here we are seeing that promoter and promoter group as one person, okay, holding 722 crore shares, 727 crore, 21,99,767,000 crore shares, right? In public, there are 27 lakh 81,000 people have invested in that public. If you want to go in depth and know about the shares, who is owning that shares, I am just going there. The statement showing shareholding pattern of promoter and promoter group. I'm just clicking that, right? Who is the promoter? Here it's the name given. So government was holding that in the name of President of India. Okay, the one promoter who holds Indian Oil Corporation, around 51.5% of the total share is President of India, right? So again, I'm coming back. There was a statement showing public shareholding. So in the public, there are around 27 lakh people have invested in that, right? So can we go in depth and see who are all the investors? Yeah, we can see it. So I'm just clicking that public thing. Here we can see first who comes first. It's SBI Mutual Fund, right? Can you see it? SBI Mutual Fund, which is having 1% of the company. Then there is a insurance companies which have invested in IOCL, which is LIC, Life Insurance Corporation of India, which is holding around 6.58% of the share, right? Then sovereign wealth fund is there. Provident fund, pension funds are holding that shares. Then there is a company called Oil India Limited and Oil and Natural Gas, ONGC, is holding around 14% of the shares. Likewise, it was going around individual shareholders like us. So we are the individual people who are having very small amount, like below 2 lakhs. There are 27 lakh people have invested in that. Right. Right. So can you see the President of India's name here? Okay. So I'm going back into the slides. So why I am telling that all the money which we are investing in bonds, mutual funds, like then insurance, whatever the money you put, right, all will be come into the share market. Because when I am buying an insurance, right, so that insurance company needs to invest the money somewhere. So they are investing in the shares. Second thing is, whenever company having um, for when you are investing in a mutual fund, right? That mutual fund money also goes to shares. So most of the time we invest in various financial instruments, and all the financial instruments goes into only one place called share market. So it was very important to understand about the business, because when all your financial instruments are going towards one particular thing, then everyone needs to understand that financial aspects, right? So now I will come again into the shareholding pattern view and also balance sheet aspects of a company, right, for better understanding. So I just explained about what is the face value of the company, and the face value is just 10 rupees. That means the original value of the shares. And because of the business was growing, we are ready to pay more for the share, right? So now I am going to show another screen, right? So instead of IOCL, I am going for some very known company, right? For example, I'm going for SBI, SBI Bank, right? So in SBI shareholding pattern, it was shown that there are totally 883 crore shares, right? And each share is value is 1. What that means, we have to check with the balance sheet of the SBI to understand about what this 881 crore shares means, right? Right. So I am using a website called Screener, which is very useful for you to read the chart analysis and results of the companies, balance sheets of the companies, to understand about that, right? So I am just showing you balance sheet of SBI from 2013 to 2024, right? You just look into that balance sheet in the year 2024, March 24. The equity share capital, that means share capital of the company, is 892 crores, right? The same thing I'm showing in the BSE website also, right? So number of shares 883 crore 30 lakhs. That means each and every capital amount, right, was converted into a 1 rupee share, right? So most of the time people think share is just like a commodity. They buy the share, and whenever the share price is going up, they are ready to sell the share. But it was not like that. You have to own the company for a longer time of period to get or reap all the benefits from the business. Because when you are investing in a business, you can't take away all the money within a short time of period, right? Then you have to give it the time to grow the business, right? So the time, if you want to do better as an investor, the single most powerful thing you can do is increase your time horizon. Okay. The time is the most powerful force in investing. It makes little things grow big and big. And when you have giving more time, the mistakes are fade away, and it can be neutralized, and your luck and risk will be reduced. But in phased result, closer towards what people deserve, is the growth, how much growth a particular stock is given. Right? How to choose a business? That's the point everyone wants to know before investing, right? So whenever people ask me about which are the shares they can buy for the long-term growth perspectives, right? Instead of particular company share, you have to choose a sector. What is sector? For example, you take IT as a sector, information technology, like companies like TCS, Infosys, Wipro. There are so many IT companies out there, right? This is a particular sector. If you are investing in any IT companies 30 years before, the entire sector is boom. Right? Whichever from the company, one may tell TCS is a good company, one may tell Infosys is a best company, another one may tell Wipro is a good company. Right? But when you go and check into the 30 years growth structure of these sectors, right? All these companies gives good returns. So instead of going for a particular company shares, you have to choose the sector first. So which sector is going to be good for the next 30 years or 10 years to 20 years, right? You have to choose the sector first, right? If you want to go deep into that, right? I will give you some example about particular sector. For example, you take financial technology, right? So all this year we know about banking as a best sector in the financial terms, right? But in the coming years, fintech is going to be a major player in the financial sector. An example I will tell you with a good example. So you take yourself, right? Before 20 years or 30 years, right? Our father, mother, they don't have bank accounts, but everything they do in the cash transactions. Once they open the bank account, right? The last 20 years, nearly each and every individual in the India has opened a bank account. But interestingly, each and every branches are getting reduced in the last few years, right? For example, in my area, there was a SBI bank, which they changed their office premises to near another place, where they are going into a smaller area. Before, they have so much of space, where around 20 people are working there, right? 20 years before, when I go to a bank, I have to wait. I give a challan to a one person, and he has to fill it in the ledger, and he have to transfer it to another person. It was going like that, and my turn will come after 1 or 2 years. Cashier will issue the cashier. But today, everything is transaction to in the UPI or in the fintech technologies. Right? So banks don't need the same space they required in the last 20 years before, which also affects the employment opportunities in the bank also. Right? Interestingly, three months before, I visited a bank branch. One thing which stuck in my mind is, I am currently 40 years of age, and I am the youngest people who was standing in that line. No one below my age is there, and mostly there was around 10 to 15 customers was there. All are above my age only, which tells that within next 15 to 20 years, the next generation will avoid to go into the bank for any kind of purpose or transactions, right? So fintech will boom, and the banking sector will exist, but they will exist in a different form. Instead of providing accounts and like that, the banks will do like, they will started selling insurance policies. They started selling home loans. They started selling mutual fund, like that. They, instead of core banking activities, they will move towards like a marketing people, right? So the fintech is the next big thing going to happen in India or anywhere in the world. So likewise, you have to choose a particular sector. Which sector is going to be very boom in the next 10 to 20 years? And you can invest any company in that particular sector, because the entire sector will boom in the coming years, right? So who can invest in a share? That's another important thing. First one is promoter. The promoter is called as the one who running the business, or mostly the owners. Most of the ownership was with the promoters group, right? Second is, one company can own another company as a subsidiary or some other thing like that. Next one is partnership firms or undivided family can own share. Some trust can also own shares of a company. For example, Tirupati temple is having a trust, and the trust was holding shares of different companies, right? So even you can donate shares to the trust. Right? And foreign nations, they are simply called as foreign institutional investors or foreign direct investors. They can own the shares. State government or central government can own the shares, and individual. So whenever you are buying a share of a company, which are the basic thing you need to know about in that? So these are the fundamental analysis which I am showing. First one is, you have to know about the income statement, balance sheet, and cash flow statements. So income statement is nothing but quarterly results and the annual results, or the income statement which displayed in the company website or in the public forum like BSC website. They will usually update for every 3 months. Second one is you have to know about PE ratios. PE ratios is just price to earning ratio for each share. So, for example, we have seen about um, Indian Oil Corporation, right? Indian Oil was trading at 143 rupees, but the face value of the company is just 10 rupees. How much the company is earning every year for this 143 rupees? How much the company is earning, which gives you the PE ratio. Then earnings per share is for each share how much amount has been kept in the reserve of that company. Okay. Then the dividend yield of the company and the total assets and debt. So for the PB ratio, dividend yield, assets and debts, everything will be available in the balance sheet itself. If you know how to read a balance sheet, then you can easily understand about all these things. So next thing is which one is so very good when it comes to an investment strategy, trading or investment. So we have to know the difference between what is trading and what is investments, right? Whenever you are buying a share and keeping the share for some small time, for example, a day, a week, or month, then there was a good return. Then you are selling it for some profit and getting away from the share. Then it was called trading. Right? In the trading, there are day traders are available and swing traders. For example, swing traders they can keep the share for some little longer time period. For example, they can keep for 3 months or 4 months like that, and they will sell the shares. Right? But when it comes to investment, right? Investors go for very long time period. For example, 10 years, 20 years like that. For both this investment strategy, we have to understand about different things. For traders, it was very important to know about the technical terms of that particular company. What is the technical term? They have to know about the volume, how much volume the company is traded every day.
Technical analysis and fundamental analysis, economic analysis, three types of analysis we are using, sir.
Okay, thank you, madam. For the trading purposes, that's a technical analysis. So, for example, I'm just telling that technical analysis for the trading purposes and the fundamental analysis for the investment purposes, right? So, when you have to clear about whether you are going to trade in a share or whether you are going to invest in a share, first make very clear about that. Then you choose the analyzing part. So when I am going to trade in a particular share, then you have to know about technical analysis. So what is the 52-week high of the share? What is the 52-week low of the share? What it comes for trading volume every day? How many number of shares are traded in that company? For another important thing is they have to know about certain things called
Economic analysis is also used, sir. Economy, industry, company, EIC.
Yeah, that also for the
EIC.
long term.
Yes, sir. Economy, industry, and company analysis. When we are looking at the company analysis, we are using financial statement to see the financial position.
Yeah, that is what I am saying. It all comes under the fundamental. Fundamental things are fundamental things covers all the aspects. Like it was a base pillar like that. So economy, balance sheet,
industry, company.
Yeah, everything comes under fundamental analysis. So, okay, I will give you some basic thing about what are the things you have to know about when it comes to technical analysis, right? First, I will show the technical part of that. Just I am sharing another window from Money Control website. Money Control is a website which was
Website, sir,
certified.
which gives all the financials of the companies, the key ratios.
Yeah, here you can see I am just sharing the shares of BSE Limited. Today BSE Limited was trading at 5,563 rupees, right? So here these are the technical things. There was a column I am just showing. The open price is around 500. This is the morning open price of that particular share. Then today's high, it was went up to 550, 5,578 rupees, right? Next one is volume. Volume, which tells you that how many shares are traded in today's trading session. So market has closed now. It was already 331 right now. So market was closed. So today there are
15,85,842 shares are traded, sir, today.
Traded, yes. That much of trading volume. Mostly people getting fear when, sir, when I am buying a share, can I sell it whenever I require? So in share market, there are crores and crores of shares are traded every day. So there was no need to fear about that. When you are investing in a good company, then trading volume is not at all a matter. So BSE is one. Today, around 15 lakh shares have been exchanged hands, right? Next one is the value. What's the value? It has value around in the lakhs, 88,000 lakhs values has been traded. Then there is another called UC limit, upper circuit limit and lower circuit limit. Mostly you have to know about what is upper circuit limit and lower circuit limit. Company which was under F&O, the upper circuit limit was given around 20% of the previous close price, right? So for BSE here, previous close is 5,466 rupees, right? From 5,466, we have to add 20%. So the upper circuit limit is 6,012 rupees. For the lower circuit, you have to minus 20% from the previous close. Why they are keeping this limit, upper limit and lower limit, is that company share doesn't go above 20% or below 20% from the previous close. It was a restrictions given by the SEBI, because if there was no restrictions, people can, it may go all of a sudden to zero in a single day, right? So to stop that, SEBI has given some mandatory to the companies. So they have to fix the upper circuit and lower circuit limit. So upper circuit is usually 20% up from higher from the previous close, and lower circuit is 20% below from the price floor. Okay. Then you have to know about 20 days moving average and 50 days moving average and 200 days moving average. This is three things are very important in there. So because when there was a huge fluctuation in the company's shares trading volume, then it will, you should not be entered into that particular share, because if you are not sure about that, right? So here, excuse me, just the technical aspects which comes under here in the first three. The next three thing I am just giving you is the fundamental things, book value of a share, right? Here it is book value of the share. The book value of the share will be calculated by how much amount, how much reserve the company is having for each share. Right? For example, around, I'm just looking into the balance sheet of the company. Right? So I'm just showing the balance sheet of BSE company. Here you can see reserves and surplus is 2,816 crore. So the company having this much of cash reserve in their account. But when you take this, this is not a company's amount. This needs to be for the owners who are having that shares, right? For each share, when you divide number of shares by 2,816 crores, it comes to around 243. That means 244 rupees for each share of BSE shareholders. So for every share, 200 rupees there is already in the account, right? Then there's EPS is there, right? This all the four things comes under the fundamental analysis. Earnings per share. For example, earnings per share of BSE Limited is 61 rupees. Okay, TTM EPS means trailing time period of last 12 months trailing months EPS, right? From now it was the third quarter of the financial year 25. From the third quarter of 24 to 25, the company has earned 61 rupees for each share as a profit. It was calculated for each, not for the whole profit. For each share, company has earned a profit of 61 rupees. Next, trailing 12 months of PE, price to earning ratio. So PE ratio gives around 91.02, and it was in the red high PE ratio. What is PE ratio? For example, I am paying 5,560 rupees for one share of BSE, and company is earning 61 rupees for each share. If the company is doing the same kind of business, okay, it will take 91 years to get back my 5,560 rupees. So which is easily understand for PE ratio, right? For so I will show you the EPS and PE for some other company, which will give you in a short term, right? For BSE, it will take 91 years to get back the amount investment. For example, 5,000 rupees I am putting. Then if the company was earning the same rate, for example, every year the company started earning 61 rupees, right, for each share, it will take around 91 years to reach that today's market value, right? Third one is book value. How much I am paying more against the book value? Already I am told the book value is 244 rupees for BSE, and then I am paying 5,500 rupees for each share. It has to be divided by the book value. Then I am paying 20 times more than the book value of the company, right? So here P is 90 times higher. So I will show you some other company. DMart, I will take DMart. So I'm showing the DMart PE ratio is around 89. That means if I am started investing in DMart for 370 rupees, it takes around 89 years to reach that 300 rupees value for this earnings per share. So another company I will show you, ITC. For example, ITC, I'm just looking into it. Here PE ratio is just 28, right? So which means if I am investing 465 rupees today in ITC, right? ITC is earning 16 rupees per share, so that I can get back all this amount in 28 years. Right. So when you are investing in a company, look into few things, right? For example, you have to look into the price per book value. Then you have to look into the PE ratio, price to earning ratio. So usually 15 to 20 is a good PE ratio, so that you can get the amount very easily from the market, right? So I'm just today just explained about only three things, that is what is book value, earnings per share, and PE ratio in the fundamentals. And in the technical things I have touched about what is the volume of the shares, what is the upper circuit limit and the lower circuit limit, what is 52-week high, 52-week low, how to understand about that. So 50-day moving average and 200 days moving average is so much important, right? Here I use this screener website for reading purposes. Here you can see, one second. So this is a chart of SBI for last 1 year. So I will change it into ITC. So you can look, there are two lines which shows in the graph, right? So I am changing it into a maximum limit for last 20 years. I will show it in the last 10 years, right? There are two lines drawn in the map equivalent to the price of the company. One shows in the yellow color and another one is in a gray color. So yellow color is an 500 days moving average and the gray color is 200 days moving average. Why I am this instinct this? So average price of the company is so much important in buying for the long term, right? Whenever the company trading above 200 days moving average, then it always, there is a possibility of going low, right? Most of the time when the company started moving upwards, the 200 the yellow line will be higher than the gray line, right? You can see in the graph, right? So when you can buy a share, so for example I am just showing the 10-year chart of the ITC, right? In this, here you can see from here to here, from the January 2022 to July 22, in these 2 years the company share price was very cheap in the market, right? Before that the share was traded at around 300 rupees, but after, during the time of corona and for the next 2 years the company share was traded around just 200 rupees, from 300 rupees to 200 rupees, right? What interesting is there is, whenever the share price was coming down, the gray line is above the yellow line, right? So when you are trying to enter into the particular script, always look into the whether the 50-day moving average is lower than the 200 days moving average, which will give you a good return in the market. Right? Either it was a short term or long term. The average price of the share for 200 days moving average and 50 days moving average I am taking. Whenever the share price is lower than the last 200 days moving average, you can buy the share without any fear. Right? So all the other aspects like PE, face value, dividend yield, everything is for the long-term investors. I have already explained, right? So up to this, I'm just closing the presentation. Excuse me. Sorry. So the technical parts already we have discussed. So most of the people ask me, how can I buy a share? So for the purpose, you have to approach a share broker. So for the share broker, um, one thing you must be very sure is whether they have registered with the SEBI or not. Check whether that particular share broker registered with SEBI. If they are registered and they are following all the uh, regulations given by the SEBI, then there was no fear. Most of the time, most of the people will ask about which broker is good, which broker is good. Can you suggest us some which can you compare this broker with that broker? So broker is just a broker when we are going to buy a house, right? Okay, or when we are going to buy a land, whether the land is important or the broker is important. So the land, of course, right? So likewise, when you are investing in a share, the broker is just they are just like a mediator between uh, ourselves and the market. Right? They just mediated between. So, which is so important is the particular company share which you are choosing, not the broker. So, for in the broker aspect, I'm just concluding that if the broker was registered with the SEBI, you can um, open the account with the SEBI registered brokers, right? So with this, I'm just closing the presentation. If you have any doubts, you can clarify. If any of the participants having any clarification regarding the investments in share market, you can clarify. Oh, madam, if anyone wants to clarify anything regarding the presentations or regarding the share market or the things like inflations or anything, you can clarify your doubts. I'll be available for next 10 minutes.
Participants, if you have any doubt, you can ask. If you all have no doubts, so sir, shall we wind up the session, sir?
Okay, madam.
Yeah, I'd like to thank today's speaker Deepak sir for making the session excellent and interactive. Thank you, sir.
Thank you, madam. Thank you.
And I'd like to thank all the participants. And all the participants are asked to fill the feedback form in the chat window. Thank you all once again.
Thank you, everyone.